Yeah, I think gold and silver, after a very long wait of years for silver, particularly gold's broken out and has tried to get to new highs several times in the last couple of years, but silver's way behind its all-time highs. It took a long time to get here, but I think gold and silver have begun big moves. I continue to say we'll see gold up at 3,000 this year, and I think that's conservative. I think, or I say pre-bust. So if the bust gets extended into the first quarter, then it might take a little longer. But pre-bust, I think 3,000 on gold is a conservative number. Silver, I have raised my target from 60 to 75, and that's a long ways away. I mean, we're down around 29 or thereabouts, 30. So it's much more than double. And the miners that go along with that, I think will get all the benefits of big moves in the metal prices. So I'm very bullish on both of the precious metals for sure.
David Hunter stated that $75 silver is pretty far off, but it might happen this year or early next year. Going from $30 to $75 is a big jump, so 3 months might be too quick. The first quarter of next year is a strong possibility, but it could even happen before the end of this year. If it doesn't reach $75, a significant part of the move could still happen in the next 5 months. Back in 2011, silver went from $30 to nearly $50 in just a couple of months. And if you look at 2020, from April, May to August, silver had a rapid and steep climb. That's just how it tends to behave.
And in a bull market for the metals, silver does outpace gold almost always. So, on the way down, gold holds up better. Silver gets hit harder. On the way up, silver has a catch up. And I don't know where the silver gold silver ratio is right now. It was up over 90, I think, but I think you could see that down to somewhere near 40 or 45 in this move. So silver definitely looks like it's going to outpace gold, and gold's going to do pretty well itself. So,
and your outlook for the miners in this melt up. Obviously, we've seen underperformance in the miners overall. Do you see that the miners will catch up?
Definitely. I think it's been frustrating for investors, because the metals woke up before the miners have, and then the miners look like they're starting to go, and then they, have corrections again. I think it is a frustrating trade, but I think there's a lot to be bullish about going forward. I think this most recent consolidation is just about done, and I think from here you see some pretty fast moves.
And back to the general stock market, what are some of your price points you're looking for? And if obviously we can't give financial advice, but I know you've said before that right now seems to be kind of a high risk situation, if you can correct me if I'm wrong, but your perspective on kind of the risk reward ratio in the stock market right now.
Yeah, what I have said, it's very tricky right now, because you would say if I'm right, we're within a few months of a top. So, you can never pinpoint a top. So if we're at the end of a 42-year run, then you're clearly in the risk period, in a period where it could reverse at any time, right? However, given the unusual period we're in, and the fact that I expect the parabolic from here into the top, you've got potentially, 25 to 50% type upside from here, even if it does cover it in, a few months. That sounds crazy, I know, but it's what we're seeing, because you're coming to the end of a very long cycle that, as I said, look at Netflix if you want to see a picture of something that this can look like. So it makes it a kind of a difficult situation, because normally the advice would be, don't think you're so smart that you can call the top. So, if you're within a few months of a top, maybe you want to get defensive. And for those that are really risk averse, maybe go, get out of the market or what have you. However, because we have potential to get returns that would normally take you 3 or 4 years to get, I mean, if you're talking about 40 or 50% returns, That's 3 or 4 years worth of returns. If you get out prematurely here, and that occurs, chances are you're going to get dragged back in. You're going to get pulled back in by your, investor psychology, by the fact that you feel you're missing something. And I can promise you at the top, you're going to have all these people who are skeptical of this market now are going to be telling you, oh, this thing has a long ways to run. There's a lot, the Fed's easing now. This thing will go for 25 and 26 and 2026 and beyond. So you're going to be caught if you got out now. You're going to be caught, let's say, 3 months from now, saying, "Oh, I missed a lot. I better get back. I can't afford to just sit here and watch it go."
David Hunter cautioned that investing at what might be the peak is a personal decision that depends on individual risk tolerance and strategy. He acknowledged the complexity of the current market situation, noting that while we might be close to the peak time-wise, we could still be far from it in terms of market distance. Hunter's market targets are significantly higher than the census, with predictions like the S&P reaching 7,000, the NASDAQ composite hitting 24,000, the Dow at 55,000, and the Russell 2000 at 3,300. He explained that despite recent corrections, markets like the Russell 2000 are poised for significant growth, especially if the Federal Reserve shifts from tightening to easing, which would benefit small-cap stocks, financials, and cyclicals. Hunter believes the market will broaden, moving from a narrow tech-driven rally to a more widespread one involving both small and large-cap stocks. Although tech stocks have recently taken a hit, he expects them to recover and reach new highs, contributing to a healthier, more diversified market. This broadening and recovery in tech will likely convince many that the market has further to grow, even if Hunter himself remains cautious.